Hello everyone, my name is Hitesh and I welcome you all in our next chapter of futures learning. In our previous chapters, we have understood the concept of futures forwards, futures versus the spot market trading. All the factors have been covered. Let us try and understand as to why futures are preferred over any other mode of derivative instrument for hedging purpose. Let us try and understand the concept of hedging first. If I were to explain it with the help of a simple example, the best example would be supposedly whenever we go to buy a car, the first thing which the car dealer sells us is the insurance along with it. Now, why does he do that? He's just trying to cover the risk which is associated with the car. Supposedly, if we meet with an accident or if we have a small theft in the car, it is very easy to get covered with the insurance policy because they will just cover the losses which you have incurred. So that in a way is a simple example of hedging the risk which is associated with the car by simply buying an insurance for the car. So to explain it in simple terms, hedging is a simple method of mitigating the risk. It is basically reducing a risk in the market. And in terms of investment or trading, we always need to reduce or eliminate the certain risk. The most of the risk in the investment market or trading market can be covered by taking counter position or by hedging with a similar instrument in the market. And in terms of trading, it is very simple act of taking basically an opposite position to an existing position in the market. If I'm supposedly holding shares of say XYZ company and I have shares worth rupees 1 lakh, the best way to hedge the risk will be to take a position which is opposite to the shares of the XYZ company and which is almost to a tune of 1 lakh rupees. So if we see a downside in the prices of the shares, the opposite position covers the risk there by making profit on the short leg. And before understanding the importance of hedging in the market, let us understand what would have happened to a portfolio if the portfolio is unhedged. Say we have an unhedged portfolio and Mr. A has a capital of rupees say 1 lakh with him and he chooses to invest in the shares of say XYZ company. The share price of XYZ company is rupees 200 per share, so by that logic he'll be able to buy 500 shares of XYZ company. And for some reason or some unforeseen technical or fundamental factors, the share price of XYZ company takes a dip and it falls down by nearly 20% to rupees 160 per share. So which actually reduces the initial capital investment of Mr. A by almost rupees 20,000. Now what are the three options which are available with Mr. A here? The first is that he holds onto a stock position and hope that the stock market or the stock price comes back. Now this is a most common mistake which has been made by most of the traders in the market. They basically hold on to your existing loss-making position and hope for a market to correct back. But we have to understand that a fall from 200 to 160 is a fall of 20%. But a move back up from 160 to 200 will be a move of 25% in the share price. So fall down is much easier compared to a move back up in the market. So which is where the holding of the stock position and hoping for a price to come back is always a risky position. Plus the time factor plays a major factor here. Even though if the share price comes back up, it might take a 15 days to 30 days, 40 days. So the interest factor associated with the investment, everything plays a major role in deciding that what kind of return we have generated or have we generated losses on our trades. The second option which Mr. A has is exit the current position and wait for opportunities for a further dip in the market. Now this has got basically two technical issues associated with it. For starter, the first thing which we'll have is that if we have exited in the market at say 160, there is no guarantee the market will fall down from there, and if the market decides to correct back up from there, it is difficult to buy the price at a higher price because it will actually or ultimately increase your entry price for the shares of XYZ company. And the second thing is, even if you get a dip in the price, what will happen with every buy or sell in the market, there is a transaction cost which is added to your investment, which ultimately makes your initial buy price higher and more time for the investment to make profit for you. And the third and the best option which Mr. A has here is to hedge his position by using a future contract. The simple thing which he can do here is this: he can short futures contract worth 1 lakh in the market and hedge against any downside uncertainties in the market. Say if the share price XYZ tumbled by 20%, even your futures contract would make you profit by 20% in the market. So which will actually cover your losses and you'll be insured against the uncertainty in the market. So that is the best way Mr. A could have tackled the position here. Now, having understood the benefits of hedging, let us try and understand how does one hedge a single stock portfolio in the market. A portfolio can be a amalgamation of many stocks, or it could be a single stock in a portfolio. So let us understand how does one hedge a single stock in his portfolio. It is very simple. You just have to take a counter position to your existing position in the market. Supposedly if you bought 550 shares of HDFC Bank at rupees 1400 And if for some reason the share price dips and we see a price come down to 1390 and we are expecting more dip in the prices, the best way to hedge here will be to take a short futures contract of HDFC Bank at rupees 1390. So what will happen here is this: supposedly if the share price of HDFC Bank corrects to 1340, then the loss made on shares of HDFC Bank in the cash market would be the existing price minus the initial bought price into number of share, which amounts to 33,000 rupees loss. But as we have sold a futures contract of HDFC Bank at 1390, that position would give us a benefit of 27,500 rupees. So the overall loss in this trade would be only 5,500, which could have been 33,000 if our portfolio was unhedged. So that is the power of hedging, and that is how it protects your money in the market. And on the next important point which could come in anyone's mind is that we know that HDFC Bank has futures contract. How about hedging those stocks which do not have any derivative associated with it? Which is a very legit question, which is very possible in the market. Now, sometimes it's possible that we have some securities or all those shares in our portfolio, they do not have any derivative instrument attached to it. So how does one hedge the portfolio? Which is where the concept of beta comes into picture. I'll be explaining the concept of beta in the next slide, but to give you a brief perspective, beta basically tells you what is the correlation of your portfolio with the overall market. Now, beta simply denotes the sensitivity of the underlying assets, that is stocks in our case, with respect to the movement on the market. To put in simple words, if the share market is moving up by a certain amount, a certain percentage, how does it impact the share price in the market? And that is what beta does. Beta gives you a calculation and tries to find out what is the correlation between the index and the stocks of the company. As I've already mentioned, the beta basically denotes the likely movement in the value of shares as against the movement in the market or index, and it also tells the correlation between stocks. In a portfolio, you have bundle of stocks. Some shares have positive correlation with the index, and certain shares have negative correlation. So a negative and positive correlation will be a part of a portfolio. So it will give you basically idea about that. What is the correlation between the shares of the company within your portfolio? If the shares are positively correlated or they are negatively correlated to each other, we can find out with the simple calculation of beta. Now, what does a positive beta signifies? Say the beta of the shares of XYZ company is 0.80 as against the Nifty index. So if the Nifty index goes up by 1%, then the share price of XYZ company will go up by 0.8%. And if the Nifty index comes down by 1%, then the share price of XYZ company will also come down by 0.8%. So that is what a positive correlation of beta signifies. And what does a negative beta signifies? It simply means, say if the beta of shares of XYZ company is minus 0.05 as against Nifty index. So if the Nifty index goes up by 1%, then the share price of XYZ company will come down by 0.5%. And vice versa, if the Nifty index comes down by 1%, then the share price of XYZ company will go up by 0.5%. That is how you explain the positive beta and the negative beta. And now this is the most important part of this chapter, as to how does one hedge the portfolio with multiple stocks. This is the most practical example which will help us. The following are some of the steps which we have to follow. The first is we have to calculate the beta of all individual stocks in the portfolio. Basically, we have to find out the correlation of each and every share against the index. And then we have to find the weightage of that particular stock in the portfolio. Supposedly, if the portfolio is worth 10 lakhs, and if I have shares of say XYZ company worth 50,000 in the portfolio, then the weightage of that share in the portfolio is 5%. Now we multiply the weightage of each and every stock with the beta value, and we add up the total results and we find the portfolio beta. Finally, the portfolio can be hedged against major future index like the Nifty index, the Bank Nifty index, or even the Nifty Financial Services. Let us understand the portfolio hedging with the help of a simple example. Say if I have 5 stocks in my portfolio like TCS, Infosys, ICICI Bank, HDFC Bank and SBI. They have their respective weightage and respective investment in the portfolio, which gives us the weightage of each and every stock in the portfolio. We just multiply the beta by the weightage and we get the total summation of all the value to be the portfolio beta. So the portfolio beta of this portfolio is 0.93. Now the next point which would come into my mind is that how much of the amount I have to hedge for this portfolio of 5 lakh rupees. So that is simple. If the Nifty goes up by 1%, the portfolio is expected to go up by 0.93%. and the Nifty comes down by 1%, the portfolio is expected to come down by 0.93%. So for a complete hedge of the portfolio, we simply have to multiply the portfolio by the beta, and we get the value of the hedge amount which have to be used for the portfolio, which is 4,65,000 here. Now what are the key takeaways from this chapter? Hedging protects us from the uncertainties. As I told you, that if you want to cover yourself against the risk, hedging is the best way or the best tool to do it. And if the long position is hedged by taking a short position in the futures market, then if the market falls, then the losses of the portfolio, that is the shares, are compensated by the short position from the futures contract. And to hedge a single portfolio, we just have to take a counter position in the futures market. And to hedge the portfolio, we just have to find the beta for the portfolio and hedge the portfolio against the underlying asset which we choose to. Could be an index of Bank Nifty or Nifty Financial Services. And the beta of the market is always assumed to be 1, and the portfolio betas are adjusted around it. I hope this chapter gave you a brief on how to hedge a portfolio, how to hedge your existing position, what is the process of hedging, and what are the importance of hedging. I'll see you in the next chapter about futures learning. Thank you so much.